is fine. Quick video today just to show you the mechanics of a merger model. When do we build a merger model is usually we build it when we want to understand the impacts of a merger or an acquisition on the financial statements on the acquiring company. So usually it's built like this. You start with a tab in which you have a small section in which you have the assumptions. For instance, you would take an assumption on the synergies, on the multiple at which you would acquire the target company, and most importantly here, you should have somewhere where you can select the proportion of share and cash components of the price. You could also have the interest rate of the debt acquisition, or the acquisition debt, sorry, and also you can have some other operating assumptions. Usually you have 4 blocks. The first block is dedicated to company A, in which you would have a simplified P&L, cash flow statement, and balance sheet. If it's a listed company, you can have those financials very easily from financial databases or from broker reports. Same goes for the target, which here is called company B. So you have a P&L, a cash flow statement, and the balance sheet. And what's new here is that we have a block which is called transaction impacts, in which we're gonna record all the impacts which are related to the transaction, whether it's a merger or an acquisition. And the last block is what we call the combined entity. In fact, this block is simply the financial statements of company A plus company B plus the transaction impact. So in fact, it's a pro forma view of company A financial statements. Once it would consolidate company B, and once we would add the impacts of the transaction. So let's see how it works. For instance, if we start with the P&L, what would be interesting to see is the financial profile of company A post-transaction. By that, we usually take a look at the growth. We see what is the growth of the combined entity, whether the merger would have a positive or a negative impact on the margins, EBITDA and EBIT margins. And a very interesting metric to look at is the accretion or the dilution of the earnings per share. So based on the assumptions that I took in this example, we see that this transaction is accretive on the EPS. So usually, it depends, but so what I'm used to see is something in the region of 2-3% accretion or dilution. And this is due to the fact that on the one hand, we add to the net income of company A the net income of company B plus the transaction impacts. And on the other hand, we have created some additional shares to pay for the transaction, since the case in which I have set up the model right now is 50% shares and 50% cash component. So since we pay part of the price by issuing shares, so we have as a transaction impact the issue of new shares. So this has a negative impact on EPS, which is offset by a positive impact on EPS due to the fact that we have consolidated positive net income of company B, despite the fact that we have a negative impact on net income, mostly due to the financial expenses. So if we spend a little bit more time on the transaction impacts, we see that we have a positive impact on EBITDA and EBIT. This is due to synergies. In this example, I have set cost synergies as 4% of the target revenues. And on the other hand, we have financial expenses because we finance half of the acquisition price through debt, and such debt costs 5% per year. And also you have debt tax shields, since we use here debt. The profit before tax is negative, and we have some debt tax shields here. So that's it on the P&L. Really, we look at the operating profile here, and we look at the accretion or dilution. On the cash flow statement, so it's the same principle. We have the cash flow statement of company A, cash flow statement of company B, from which you can obtain from uh, public sources or financial databases. And in terms of transaction impacts, here you see the impact on EBITDA, which is related to synergies. Uh, in terms of financial investments, since here you would record the acquisition price, and here you will see how this acquisition price is financed. Since we have set up the model at a case which is 50% equity and 50% debt, you see that half of the price corresponds to a debt issue and half of the price corresponds to a capital increase. So in order to have the, the pro forma cash flow statement of company A, just need to add company A to plus company B plus transaction impacts. And here you have just, I mean, you see all the formulas, just the sum of the three blocks. And last, one very interesting thing that we usually look at is the leverage ratio. You see here I have the leverage ratio of company A. By the way, leverage ratio is defined as net debt divided by EBITDA. This is a metric which is very widely used to assess the strength of a balance sheet. It is looked at by by the creditors, such as the banks, for instance. And in this example, we have a company A which has 1.5 times leverage ratio, and we see here that after the transaction, the ratio would deteriorate to 2.3 times. So this is due to the fact that there is some additional debt, and usually depending on the industries, when this ratio increases above a certain threshold, the company would have some trouble to access debt capital markets or debt financings in general. So really that's it. Those are the most simplified way. Those are the most usually looked at items. And what we could do also is see how those numbers would change when we change the case. For instance, if I use 0% equity, which means that the company A would fund 100% of the acquisition price through acquisition debt, you see that the accretion increases because we don't have to issue any new shares anymore. You see here in the cash flow statement that 100% of the acquisition price is financed through a debt issue and thus zero through equity. And you see, most importantly, that the leverage just explodes. It increases dramatically because 100% of the acquisition debt of the acquisition price is financed through acquisition debt. So that's it. And the last thing we usually check is the dilution of company A shareholders. Since here everything is financed through debt, you see that their stake remains at 100%. If I use 50% share financing, you see that there is a dilution here. So their stake moved to 70%. Okay, so that's it. It's a very quick overview of the mechanics of a merger model. If you have any questions, you can just contact me through the blog. See you later.